For 15.3, we are computing and allocating the partner share of income and loss. So just like sole proprietorships, partnerships make 4 entries to close the books at the end of the year. The entries for the partnership are debit each revenue account and credit the income section for the total revenue, credit each expense accounts, and debit the income section for total expenses. So we clean out the revenues, we clean out the expenses. Then where does it go? Because with a sole proprietorship, it goes to the owner. Well, when it goes to a partnership, how much goes to each partner? So if the partnership had income, debit the income section for its balance and credit each partner's capital account based on his or her share of the income. If the partnership realized a loss, credit the income section and debit each partner's capital account based on his or her share of the loss. And then credit each partner's drawing account and debit each partner's capital account for the balance in the same partner's drawing account. So we've done this before. With sole proprietorships, the only difference is how we're allocating the income and losses. So this should feel somewhat familiar. So we take from income summary, which is where we dumped all the incomes, we dumped all the expenses. Looks like we made $50,000. Then we're going to give it $50,000, or excuse me, half and half, $25,000 to Dale, $25,000 to Sierra. Really easy. So for income allocations, not every partnership allocates profits and losses evenly. The following are examples of ways to typically allocate income. A fixed ratio where income is allocated in the same way every period. The ratio can be expressed as percentage, 80%, 20%, proportion, 7-3, or a fraction, 1/4, 3/4 examples. A ratio based on the beginning of year capital balances, end of year capital balance, or an average of the capital balance in a year. This encourages partners to keep capital in the business instead of pulling all their capital once they've invested it. So if the ratio of income is based on how much capital you have in the business, you're more inclined to leave more capital in the business, which helps the business because it gives them money to operate. 2, partners may receive a guaranteed salary and the remaining profit or loss is allocated on a fixed ratio. So if Bob and John have a partnership, but John works in the business full time, he's going to get probably a salary, and then the profit and loss comes after the salary was paid out. And so he might get less or more based on that he's getting a salary regardless. And then 3, income can be allocated based on a proportion of interest in the capital account. If one partner has a capital account that equates to 75% of the capital, that partner would take 75% of the income. His money is the money that's in the business they're using to make money, so kind of makes sense. And then 4, some combination of all or some of the above. There's just so many different ways you can write this up. Salaries and interest paid to the partners are considered expenses of the partnership and therefore deducted prior to the income distribution. Partners are not considered employees or creditors of the partnership, but these transactions affect their capital accounts and the net income of the partnership. So, for example, this Acorn Lawn and Hardscapes reports net income of $68,000. The partnership agreement has a defined income sharing ratio which provides for salaries of $15,000 to Dale, $10,000 to Sierra. They will share the net income on the 50-50 basis. So they made an income of $68,000. Then they're going to give them their salaries, $15,000 and $10,000. So that takes $25,000 off that, leaving only $43,000 left. So then they're going to split that 50-50. So they're each going to get $21,500. So at the end of the day, the income was divided $36,500 to Dale, $31,500 to Sierra. Now consider of net income they realized a net loss of $32,000. The salaries for Dale and Sierra would remain the same. Also, the distribution process for allocating the loss is the same. So let's do that. So we lost $32,000. So the salaries paid out $15,000 and $10,000 when they've already lost money. So that just adds to the loss. So in the end, they have lost $57,000. So how do they split that? They take 28,500 from Dale, and Sierra 28,500. So if you add the salaries were pluses, the losses were minuses. He would end up with a 13,500 loss, and Sierra would end up with an 18,500 loss.